Okay, none of these numbers are right, just so you know, because I didn't rewrite it. And maybe my handwriting is going to bite me in the ass more as we go. But estate and gift, this is the basics for estate and gift, is what this is. Okay, annual gift exclusion, lifetime estate and gift exclusion. Okay, those two items are completely separate and distinct operational items in the estate and gift arena. So the annual exclusion says, in general, that I can give away up to 17,000, which I think it's 18 now.
For 24, yeah.
So you might want to write that down in your book. This for 24, it's 18,000. I can give away $18,000 and have that not harm my lifetime estate exclusion. So what does that mean? And why do I care? So if, and we're going to cover this, if I'm worth, I'm going to call it $13 million, and I can assure you that I'm not, that if I die with $13 million in my bank account, that I can transfer $13 million to Brett, who would be very happy if he got my $13 million, and he'd have $13 million, and the government would not get a dollar of estate tax. Okay, so let's pretend that I happen to be worth $13,170,000. Let's pretend that that's the number. So 170, which is my point. For 10 years, there's no growth in my money. It's all static. I say, well, I don't want to pay a dollar to the federal government. So, Brett, I'm going to develop a strategy, and I'm going to give you $17,000 a year for the next 10 years because I'm going to die in year 10, just under my fact pattern. So I give him $17,000 for 10 years, and my estate goes from being worth $13,170,000 down to $13 million. So now, by virtue of this annual exclusion, I can use that to deplete down my estate and transfer dollars to the next generation and have it not harm my estate exemption. That's really the point of the annual exclusion. So, and I probably already went ahead. Jackson, what's number one say here?
What is the difference between annual gift exclusion and lifetime estate and gift exclusion? Oh, how very confusing. What is a new staff person to do? You have to simultaneously understand how the annual exclusion and the lifetime exclusion are the same, but not the same at all. How do we start to understand? Let's start by examining the lifetime estate and gift exclusion.
Okay, what's two say?
What in general is the lifetime estate and gift exclusion? It is the amount that can be transferred to the next generation without a tax being due to the IRS. This concept by itself is confusing and needs to be explored.
Yep, keep firing, kid.
Okay. How do we explore the lifetime estate and gift exemption? First, all you need to understand that the amount in excess of 12,920,000 exemption is subject to a 40% estate tax. You want me to read the example?
Pass it to somebody else.
Okay. Let's go, Luke.
Let's assume Pete has assets with fair market value of 17,920,000 with a tax basis of 7,920,000. He was in an unfortunate accident and died. All his assets were transferred to his family. And then let's see. So then take the gross estate, subtract the exemption, and that's 5 million of taxable with a rate of 40%, and that's 2 million of tax. And then he gets to give around like 15,920,000 to his heirs.
Okay, what's the four at the bottom say?
So the tax basis and the holding period are very interesting. Tax basis equals the fair market value at the date of death, and the holding period to the decedent acquisition date. If we assume that 17,920,000 of value was Lutz stock Pete acquired in 2007, then the decedent's heirs holding period would be 2007.
What do I mean by holding period? Do you know what that means?
I'm not sure.
Okay. CV?
I should, but I don't.
Allie? Chris looks like he has a stab.
I was focused on something else. I was going to call you up for disability errors.
That ain't gonna count. That's not gonna get you there. I almost have engineer spelling, so. Holding period, Max?
Like stock, it would be considered, if you sold it right away, it'd be considered either short-term, long-term.
Okay. So how does that relate to what that says up there, though?
So if, based on the fact pattern, if your date of acquisition is in 2007, longer than the holding period of the year, which would make it long-term, which would give you preferential rates.
Me or the people that
The
inherited it?
people who acquired the stock after death.
Okay. Holding, that means that the heirs are going to deem to have purchased that stock in 2007. So Max is 100% right. When they go to sell that stock, they're going to say, well, we sold it December 31st, 2026, but the holding period was 2007. And it appreciated from 15,920 to 20,920. There's a $5 million gain. That $5 million gain, by virtue, or let's just do it the day after. You know, I die today, they get it tomorrow. Let's strikes oil. There's appreciation of $5 million that goes into the stock. Even though they only held that stock for 1 day, they're deemed to have held it since 2007, and they're going to get long-term capital gain. So there's two things that happen. One, I bought the stock for $1. I, Pete, bought the stock for $1. It was worth $15,920 when I died. So it gets stepped up from the $1 that I purchased to. They're deemed to have purchased it for $15,920. So when they measure gain loss in the future, their basis in that stock is $15,920,000. And if they sell it the next day, and it's worth $20,920,000, there's a $5 million gain from the date I died to the date they inherited it. And even though they sold it 1 day later, it's still long term because there's a presumption that they bought it back in 2007. Okay. Note this is not reduced for the 17 annual exclusion, which we talked about. Let's see. Carter, what's this say?
How do we explore lifetime estate and gift exemption? Example, let's assume Pete has Lutz stock worth $17,920,000 with a tax basis of $7,920,000. He believes that Lutz is going to appreciate. He gifted the stock worth $12,920,000 to his children. He unfortunately passed away the next day. The gift amount was $12,920,000. He's using his full exemption, which leaves him with no taxable amount.
But that's for the gift side of it.
Yep. The value of the assets when he died were $5 million.
Because I died the day after.
Yep, he used his exemption, his full exemption. So
let's talk about what's happening here because it's confusing. Okay, so if the date of gift, let's go back to the annual exclusion. CV, what was the annual exclusion?
18,000.
18,000. Let's say I give you $118,000. Can I shield some of that with annual exclusion? I can. How much?
18,000.
But now there's an excess, correct?
Yeah.
How much?
100,000.
$100,000. So that $100,000 would erode my lifetime exemption of $12,920,000. So that $12,920,000 in this example, which is higher, I can either give it away all in my lifetime, or I can give away nothing during my lifetime and use it all when I die, or a combination. Okay? So in this example, I gave it away all in my lifetime. I didn't know I was going to die tomorrow, though. Okay? So I gave it all away. I have a gift amount, and I probably say something about 7,000. I don't know. Okay? I give it all away, or give away 12,920 because that's my lifetime exemption. I think it's going to appreciate. We're going to demonstrate what that appreciation means and why I'd do it. My taxable amount, or the amount I had to pay tax on was 0 because I used my lifetime exemption to shield it. But then I die the next day. Well, I have $5 million of stuff left over. So they say, okay, start with the stuff that you have left over. But then when you do your estate calculation, add back all the amounts that you shielded with prior exemption. So we have to add back the amount to get to the prior exemption to go from 5 million to 17,920. Then they say, what's the current exemption? Because that goes up and down. It's going to fluctuate with inflation and otherwise, which leaves me 5 million left over, 40%. I pay 2 million tax, the same as if I died without using the exemption in the previous slide. Okay, so, that's interesting. CV, what's A say?
When assets are gifted, tax basis equals carryover, or 5,710,179. The holding period of 2007. Whose is the same as Pete's? B, as in prior example, inherited assets basis is equal to fair market value, or 3 million. The holding period is equal to Pete's holding period. of
3 million, what the fuck am I talking? Oh, because I had to, 3 million, it's 3 million because I had to dispose 2 million of it to pay the estate tax. Like 3 million, what the hell am I talking about? Okay, so let's talk about A for a second, because what A says is, well, no, let's take a step even further back. When I waited till I died and 17,920 passed to the heirs, and they ended up with 15,920, there were two things that happened. One is there was a step up to fair value. So there was 15,920 of fair value that was the basis in my heirs' hands. And then the holding period went back to 2007. So if they sold it the next day for $5 million, it's still long-term capital gain. That's what happened there. So now let's compare that to what just happened. I gave away 12,920,000 yesterday. And when you transfer a gift via a gift, when you transfer an asset via an inter vivos or lifetime gift, what happens is you have to erode your exemption. The heir gets that asset with carryover basis, and they get holding period. So instead of getting a step up in the asset, it has carryover basis. So what this math is doing says, well, I have 12.9 divided by 17.92, and I think the basis in the previous page was, wasn't it like 7,920? Is that what the basis was on the previous page?
I think so.
Yeah, 7920.
Okay, so 12.92 divided by 17.92 times that 79.20 a basis means that my heirs basis, and that's probably, is 5,710,000. So they have 12.9 of stock value with 5.7 of basis with a holding period of 2007 because I gave it to them during my life. You can give it away during your life, but they're not going to get the step up. Okay, the 5 million that washes through the estate gets stepped up to $5 million. There's 40% tax, $2 million of tax. The estate had to sell $2 million worth of stuff to pay the tax, because it has to pay the tax, which leaves $3 million of stock left over, with $3 million of $3 million fair market value. 5 minus 2. Oh, look, I did do that. Okay. And the holding period is still 2007. So the punchline, or what you need to know, is life gifts made during lifetime have a carryover basis with holding period. Lifetime gifts that are below the annual exclusion can be shielded from tax, and tacking a holding period works. At death, you get a step up. The holding period is the decedent's holding period, and life is probably, at least, I'm not going to say that because we're about ready to demonstrate why it's not better to say that. Okay, let's see.
Have you mentioned at all that the annual exclusion is per individual you're gifting it to?
Not yet, but we can. Go ahead.
So I can give 18,000 to Max, I can give 18,000 to Jackson without impacting my lifetime exemption. It's not 18,000 total for the year, it's per person you're giving it to.
Oh yeah, that's not where I thought you were going with that. Okay, but that is a good point. It's that 18,000. I didn't even occur to me that that's what I was saying, and not saying it. I can give 18,000 per individual, as you noted, but that's not where my head was at because I assumed that was obvious, and it probably wasn't. Okay, but where I thought you were going with that was, I can give my sister and her husband, I give my sister $32,000, or 36,000. There's my math again. 36,000 to my sister. It didn't come from my wife. It came from me. But there's something, and I think we even do this in here some. Now that we're saying this. Yeah, I think I do this in here somewhere. I can pretend via tax return that I gave $18,000 to my sister, and that my wife, even though she didn't give $18,000 to my sister, I can, as long as she agrees, I can use her annual exemption to transfer more to somebody that I want to target. So there's really two things. To Brett's point, wait a minute, you weren't really clear, or you weren't as clear as you could be, that the 18,000 is not just this microcosm of small numbers. It's 18,000 per person. That's a great distinction in terms of understanding that. And if somebody thought it was just 18,000 and Brett clarified that, that was a great point to bring up.
Because on your previous example, where you said you gifted 12,920,000,
I didn't erode it for.
you didn't erode it for that exclusion, and you just said children. You didn't say how many children, so how big that number should be knocked down.
I'm not sure, but actually I think I get into present interest in here, which is going to talk about that very thing. So while that is a flaw in that slide, I think I'm highlighting it as we go. I think maybe not. If I don't, we're going to do it on the board. Okay. So why the hell would a taxpayer gift something earlier in their life? Okay. And the answer is that what you want to do is identify the highest appreciating asset. Let me back up. That's a little too black and white. Because I believe this to be wholeheartedly true. There's two things in taxation that I believe are just super personal. There's no tax answer, because you got to figure out what it is the client wants to do. If a client says, hey, I'm making $1 million this year, should I give something to charity? Well, the question is, do you want to give something to charity? You shouldn't give anything away to charity unless that's what's in your heart. I mean, the tax advantage, the tax savings is a good thing, no doubt about it. But I make $1 million and I give away $100,000 for a tax deduction, which saves me $400,000, but I gave away $1 million. Well, it just cost me $600,000. It makes no sense. It makes no economic sense. So if you have charitable intent, hell yeah, do it. If you don't, keep your $600,000. That's very personal. And when it comes to estate planning, this is all very personal. So I can say, wait a minute, if we need to maximize your estate, the client might say, I want it all to go to charity. I don't want anything to go to my kids. So you have to figure out what the client wants. You have the world's best strategy to save tax, but it doesn't suit them for who and what their goals are. So the starting point is, what are your goals? What do you want to have happen? Now this particular client says, I want to maximize the amount that goes to my children. And they say, okay, Max, what's this say?
How do we explore lifetime estate and gift exemption? Example, let's assume that Pete has, let's stop. Yes, I'm sorry. 17,920 million with tax basis of 7920. Who believes that Lutz is really going to appreciate? He gifted 12,920,000 to his children. He passed away 20 years later.
Okay, so this little grid says, okay, at the date of gift, he gave away 12,920 and retained 5 million. So that's that first line. The second line says, you know, he's kind of right. Over the period of time, the stock appreciated from 5 million to 15 million, and the 13 million went to 39 million. So he's right. So now what you have to do is that same calculation that says, how much value is in Pete's estate? 15 million. How much prior exemption did he use as part of his gifts? 12,920,000 because he gave it away 20 years ago. That means the taxable estate is 27,920,000. Then you take out the exemption of 12,920,000 and you have 15 million estate, the same way you have 15 million up here, times 40%, and you have $6 million of tax that you have to pay. Okay? All that feels very similar to what we had before, I think. And what you have is basis in the 12,920,000 that was the original gift of 5,710,000 the same way, but the value at the date of death of 38,760,000 versus the amount of exemption that I used, there was appreciation of 25,840,000. From the date I transferred that asset, there's 26 million of appreciation. If I did nothing and I kept all the assets in my estate till the date I died, my estate wouldn't have had 6 million of tax. It would have had 17 million of tax. I saved $11 million of estate tax because I took an asset I thought was going to be highly appreciating out of my estate, transferred it to the next generation, and let the appreciation post that transfer over the 12,920,000 in this example escape estate taxation. Annual exclusion, which you should say $18,000. Sam, what's this say?
What is the purpose of the $18,000 annual exclusion? It is a mechanism that allows for some level of wealth transfer that does not reduce a taxpayer's $12.9 million lifetime exclusion.
Okay,
Do
go
the
ahead.
example. Example 1. Pete transfers, make it 18,000 to each of his 4 children for a total of whatever that math becomes.
Yep.
Does the transfer for Pete's, what does that say? Does it transfer, is it impact?
16,000 transfer.
We need a
It
verb.
should say harm.
Does the transfer harm Pete's lifetime exclusion? No, Pete is able to transfer, we'll just keep it 17 to any person and have it not harm his exclusion.
Okay.
What is the income tax consequence to his children? None. Does the transfer to his children reduce his estate? Yes, it does.
Okay. Sam, who you want to call on?
Calling CMC Connor over there.
CMC?
What if we're in example 2, right?
Yep.
What if Pete transfers?
And we'll keep it at 17, even though we all know it's 18, because that's just how the damn things were constructed. Nope, you're good. I like your precision. It's good.
What if Pete transfers 117,000 to one of his children? Question 1, what is the amount of the gift that reduces the 12.92 million annual exclusion? The current year gift of 117,000 minus the annual exclusion of 17,000 gives you a reduction to the lifetime of 100,000. Lifetime exclusion 12.9.2 minus 100,000 gives you a remaining lifetime exclusion of 12,800 or 12,820,000.
Okay, all that's clear based on what we talked about so far? Okay, hopefully we're going to be talking about present interest here soon. Oh, look at this. Who you want to call on? CMC?
Matt.
Are there requirements in order for a taxpayer to utilize the 17,000 annual exclusion? Yes, the person receiving the gift must have a present interest in the gift received. What is a present interest? It means the recipient has unfettered control over the gift. Can you diagnose unfettered control in the following? Question 1. Pete received 17,000 from his dad. He went to the casino and lost it all. You saw me keep going on the question.
Question 2, yep.
Okay.
And then we'll-
Pete's dad thinks he is irresponsible. Therefore, Pete's dad put 17,000 into a trust. Pete can't get the money for 20 years. Question 3. Pete's dad transfers 17,000 to him and tells him if he does not invest the funds in the S&P 500 that he, Pete, would never get another gift. Question 4. Pete's dad transferred 17,000 to a trust. Dad tells Pete that he has 30 days to withdraw the cash. If Pete does not withdraw the funds, he can't get access to the funds for 20 years. Crummy letter. Pete's dad tells him he will never get another gift if he withdraws the money.
Okay, so in question 1, Matt, does Pete have unfettered control?
Yes.
Because he can do whatever the hell he wants. Chris, in question 2, does he have unfettered control?
He has no access to it for 20 years.
So does he have unfettered control? Okay, so present interest means that you have to have unfettered control. So Matt, do you think the 17,000 in question 1 harms the lifetime exclusion?
No.
Chris, in question 2, does it harm the lifetime exclusion? It does, because Pete does not have a present interest. CV, what about in question 3?
Dumb question, what's unfettered mean?
It means that I can do whatever the hell I want with it. There's not a barrier. I can do whatever the hell I want. I can withdraw it. I can go put it on black at the casino on the roulette table. Unfettered means I can do what I want. There's no restriction.
Then what was your question for?
Does Pete have unfettered access in question 3?
Yes.
He does. Even though Dad's going to pound him into a pile of pulp, if he does it, then that's a different matter. He has absolute access and control. Who do you want to call on now?
Carter.
Carter, read the facts in 4 again, just to make sure we're all on the same page.
Pete's dad transferred 17,000 to a trust. Dad tells Pete that he has 30 days to withdraw the cash. If Pete does not withdraw the funds, he can't get access to the funds for 20 years. From the
Okay.
letter, Pete's dad tells him that he will never get another gift again.
Okay? Does he have unfettered access?
No. Yes, he does.
Which way are we going here?
I think he does.
Okay, he does. He has unfettered access for a period of 30 days. So what happens, there was a court case called Crummy, and this I think he was an attorney, said, you know what, I'm putting this into the trust on your behalf. You have, and he sent a letter saying you have 30 days to withdraw this out. And if you withdraw it out, it's yours, and you can do whatever the hell you want with it. And on the side, he said, oh, by the way, if you do that, you're never going to see another nickel, ever. So even though there was this compulsion of you better not do it, they did have the opportunity to do it. And since they had the opportunity to do it, that was called a present interest for gift tax purposes. So you see this a fair amount. And this manifests itself in something called an ILIT, which is an irrevocable life insurance trust, where a rich person says, hey, I got $13 million worth of estate. I want the estate to have a funding mechanism to pay the tax. So I'm going to put a policy inside of a trust for $5 million, whatever the number is, to pay the estate tax. And every year, that policy requires, in my previous example, $68,000 of insurance premium to fund it, because that's what I could give to my kids. So then I ship off $68,000 to the trust. I send a letter to my kids saying, do you want the money or not? No, Dad, I don't want the money. The window closes. The $68,000 funds the life insurance policy. And now what I have is $5 million sitting there for when I die. Then the $68,000 that transfers to that trust is not a harm to my exemption. Now I have $5 million sitting there. The estate, I die. The estate now has a $5 million liability. The trust says, hey, I'll buy $5 million of your assets, estate. It harvests out $5 million of assets, transfers $5 million of cash. The $5 million of cash is then used to pay the estate tax, and my estate remains whole. So this transfer to a trust with this crummy letter is something that you see a lot in an estate tax. What's this say, Carter? Oh, did you guys understand what I was saying about gift splitting? Okay.
What if people are married? Can they both make gifts of 17,000 or 34,000 for married couple? Yes, each person can utilize the 17,000 annual exclusion as long as the transfer meets the present interest requirement.
Go ahead.
What if a wife transfers 34,000 to her child from a previous marriage? The husband transfers 34,000 to his child from a previous marriage. Do these transfers meet the annual exclusion? Yes, there is a concept of gift splitting. 6, what is the concept of gift splitting? This is when a spouse makes a transfer and they use the 17,000 annual exclusion and they utilize the spouse's 17,000 exclusion for a total of 34,000.
Yep. Okay. Yeah.
So could you theoretically get divorced then and then have 2 lifetime exclusions? Like if you were to split the.
You know what? I was thinking about this earlier, that I was doing this a disservice. And I kind of gave up because I'm tired and old. Okay. You get 13 million and your spouse gets 13 million. And I don't want to muddy the water too much, but I'm going to go, I have 13 million and my wife has 13 million. If I pass away and my estate is 10 million bucks, okay? That means there's 3 million that was not utilized. There's a concept of portability that says that $3 million that was unused by my side of the estate can be picked up and ported over to hers, and now she has her 13 million plus my 3 million to exclude. But you have to make an election in the tax return, the estate tax return, in order to do that. I mean, it's a great question. That's right up to Brett's, hey, dumbass, you called it a bucket of 17,000 or 18,000. That's exactly what I just did with that. Now, that's 100% right.
What happens in a case of like one spouse passes away? Like, is there like still like separation there? Like, or is it like everything from spouse one that is now with everything with that was with wife who passed away is now with husband, and husband now can only give 17?
The husband can only give 17.
So like if they previously, so like
Gift
let's say
split.
you're,
You cannot
Yeah, your
gift
kid.
split with your dead wife.
okay, so like your kid, so like you're receiving 34,000 from your parents every year.
You lost your mom plus 17.
Okay.
Is what that is.
There's also no gift exclusion rules for transferring between spouses.
Yeah. Code section 1041 is what Brett's talking about. Yeah.
So when you're giving like the stock, and let's say there's a loss instead, do the children like carry on the loss then?
No. So let's think about that, because it's fair. So my stock had a basis of 7.9 million, right, in the previous example, and you're saying, well, if it's worth 5 million, there's almost a $3 million loss. Do my kids get that loss? Nope. But also the flip side of that though is that my annual exclusion isn't harmed by 7.9, it's harmed by 5 million. And if my basis in that stock happened to be 7.9, I made a poor investment, well, that $3 million variance is just going to disappear because their basis in that stock is going to be 5 million. The holding period is still going to be 2007, but transfer of a loss item depletes down to, for basis purposes, to what the value is that harmed your exclusion. In my example, that was $5 million. I wish I looked at this before I got here. Are you any good at tax returns?
Maybe. It depends.
Is that a real depends? Are you just yanking my chain?
No, it depends.
Okay, so line 1, enter amount from Schedule A. Line 2, enter amount from Schedule B. Boy, I really wish I looked at this. Okay. Okay, so let's back up for a second. Enter line from Schedule A. So for your purposes, Schedule A is the current year gifts. And more precisely, that's your current year gifts less the current year exclusion. Those are the amount of the taxable gifts that you made that are harming your exclusion. Schedule B is the gifts that you made in the past, and then line 3 is the addition of line 1 and 2. So going back to my earlier example on my estate return, this is very similar. It said, hey, I had $5 million in my estate. I died the next day. There was 12.9 of amounts that I previously gave to get to 17 million. That is a concept embedded in the estate return, but it's the same concept is embedded in the gift tax return. So in this case, if I gave the 12.9, and I'm not dead, this is gifts, the year before, 12.9 would be line 2 in that previous example. And I gave away another 5 million this year after exclusions, after gift tax exclusion, that would be 5. The addition of those would get to 17.9, and I believe this is going to appreciate, and I'm willing to pay gift tax today, so let's talk about that. Because we did it in the context of an estate return. If I can give away more than 12.9, I'm just going to have a tax that's going to be inflicted on me. So year 1, I gave away 12.9, which I paid 0 tax on because that's my exclusion, lifetime exclusion. Year 2, I really think this thing's going to go, and Brett advised me, paying tax today versus the appreciation that's going to occur, it's wise to take that tax hit because that 5 million is going to be worth 100 million, and I'm going to be saving a lot more money, or my kids will. So I give away 5 million, that's a current year gift. I gave away prior gifts of 12.9, that gets me to 17.9. This comes down and says, what's your exclusion? 12.9, 5 million of gifts, 5 million of gifts times 40%. I'm going to have $2 million due with this return because I exceeded my lifetime exemption. So Schedule A is what's my current year gifts. Schedule B is what's my prior gifts. You got to add them together and compare that to what your overall gift exemption. And the purpose of me putting this in here is you're probably going to, has anybody prepared any gift returns in here? okay, Carter has, you're probably going to see a gift tax return. And knowing that these lines exist, when you go to do this, probably doesn't hurt. Okay, so these amounts summarize the current year gift by person. Summary goes to the next page. 161. Okay, so from the previous page. So the previous page says, I gave away $117,000 to Brett. That's what the previous page is going to say. Okay, this up here. This summary is going to say, I gave away $117,000 to Brett. That's what this page is going to say. This page is then going to populate down to this Part 4, taxable gift reconciliation. Well, I gave $100,000 to Brett, so now he can go take it to the casino and put it on black. So does he have a present interest? He does. Okay, so going back to my 117, I gave Brett 117. Now he can go put all 117 on black, and now that means he has present interest. That means that 17 is excludable. So it'd be 100,000 less 17 to get to 100,000, and then this amount goes to page 1. So that this now says 100,000. Again, let me say it again. I gave him 117. It's summarized on that first schedule that we talked about that says what's the total gifts, 117. Then you have to measure if you have a present interest. It goes to the next schedule. He does have a present interest, so we're able to reduce that down to measure taxability of the gift, and line 1 is $100,000. Then Schedule B, all right, whatever. This summarizes made in prior years that is harm/reduced the taxpayer's $12.92 million. Okay, so let's stick with that fact pattern. Year 1, I gave Brett $117,000. 17 was excluded because of annual exclusion because he had a present interest. 100 was harm. Now we're in year 2. I give him another $117,000. Same process. Summarized in the first schedule, $117,000 worth of gifts. Goes to the second schedule, present interest, yes or no? Yes. Reduced by $17,000. Now that summary kicks it back to page 1. Kicks it back to page 1, that's 100. Then it says, well, were there any past gifts? Well, yeah, there were. In year 1, there was $100,000. So line 2 we populate with 100. So now line 1 is the current year gift. Line 2 is the prior year gift. The total gifts made in the lifetime today is $200,000. And my 12.9 will be harmed by the prior gift. Current gift go from 12.9 down to 12.7. And I think if I was smart enough that we do an example. Okay, taxpayer A transferred cash to daughter B in the amount of $134,000. Okay, and taxpayer gift splits with his wife. Let's see. Taxpayer made a gift in 2007 to daughter B in an amount of $234 and he gift splits. So this is a current year gift. This is a prior year gift. So Schedule B would populate with a 2002 gift of $100,000 and 2007 gift of $100,000. So the total gifts made in the past is $300,000. Hopefully I was smarter than that. Did I make another gift? I didn't. That was solely to demonstrate Schedule B quantifies the prior gifts. Okay, so when you guys, I didn't do this the first time I did this because I actually read through it and gave it some thought about what I wanted to say. It was better than this one. However, I do think maybe when you look at a gift tax return, at minimum, you understand that there's a current year gift, there's prior year gifts, there's an annual exclusion that comes into play. You have to measure whether there's a present interest that is going to reduce that gift one way or the other. So with that said, are there any questions? Yeah.
I believe, aren't there certain gifts you can structure so the whole thing doesn't touch your exclusion amount? Like if you pay it to a certain, like if you pay it directly to a college for your kid,
Yep.
you don't have to touch any of that.
Yes.
So I was just gonna ask, like, is that pretty common in like real life when you're talking about this, making sure they, like, instead of sending 50,000 to the kid and then the college, like, I didn't know if that was actually.
No, it happens. 100% that happens. So what Jackson is talking about is, well, I have 4 kids and I have to pay 4 kids worth of tuition. If I give them the $50,000 that Jackson's talking about, and it just sits in their bank account and they pay their tuition with that, is 50,000 more than 18,000? It is. Or, God forbid, one of my kids is sick and I got to pay their medical bills. Is that a gift? So there's these exclusions, and the two that are most common is, or if it's a niece, nephew, whoever. You can pay amounts for medical bills and tuition and have an unlimited exclusion to the extent that you're actually paying that bill. So if somebody's going to Harvard and it costs $150,000 a year, I have no idea if that's what it costs, I can send a check directly to Harvard on behalf of Jackson and pay his tuition and not have that be a harm. Now, do I report it on here? I don't think I have. Probably should. Or, God forbid, Connor was sick and I had to pay a hospital bill. I send it directly to the hospital, not to Connor, but directly to the hospital. That also has the same exclusion. Yeah.
So what if you gift like the 50K that you're saying for your 4 kids, and like one of them doesn't end up using any of it towards tuition? Like, what would be the tax treatment with that? Like, you just made a gift that
Did it go directly into their account?
it did.
Like, no, to that. Well, no, it has to go directly to the institution, Carter.
Oh, so it has to like be paid like straight to like Creighton, for example,
Yes.
or UNL?
Yes.
Because you said something about like a bank account, so I didn't know if.
No, I'm saying if I put it in their bank account, now I'm measuring that using the $17,000 or $18,000 is how much does not harm my exemption. If I send it directly to Creighton, then and it doesn't stop or go to my child or whoever, then the $17,000 turns off, and it's the amount that I paid for their tuition is the excludable amount.
Oh, okay, I got you.
And that's the same with medical bills. So,
But you don't report it on that usually.
I don't know.
Okay, I didn't know.
It seems like you should.
Okay, yeah,
It does. It seems like
it would just be a non.
yeah. I
Yeah.
would take the full exclusion on here. I have no idea.
I've never seen it reported like that under that facts.
Have you ever had somebody pay tuition directly or medical bills directly? I have too, and I've never reported it honestly. But to say whether I was required to or not, there's only 2 answers. The answer, and I don't know. In this case, I don't know if I was required to or not. But what allows me to sleep at night, Jackson, is if I get busted on that, fine. I'll throw on $100,000 worth of extra gift and $100,000 more of exclusion, because it is in fact excludable.
Right.
Do you know all the rules on when you can take a gift ratably over 5 years?
Kind of. I mean, I know what you're talking about. To say you're talking about a 529 plan, and I'll let you, if you're okay, talk about that, because I kind of think there's a nuance in here that I miss.
I don't know it exactly, but if like a grandparent wants to give money to their grandkid for college, they can gift a lump sum directly into a 529 plan and treat it as gifted over 5 years. So you can give $100,000 and you can say, I'm going to treat it as $20,000 this year, $20,000 next year, and so on, instead of a $100,000 gift today. I think
that's right. Yeah, but there's something always confusing about that, but that's 100% right. I would say see Ben Burton, right, if this comes up for that. Does anybody have any questions about the very basics of basics for estate and gift? At all?
What
Yeah.
if you're gifting something that's like non-cash?
That's a great question. Okay. Sam asked a great question. Because now, I mean, there's all sorts of complexities that go along with this. And I'm trying to, who's my expert? You? Are we here foundational or experts?
Foundational.
Okay. And what I've tried to do is, I know that you guys over the next 6 months or a year or 2 years are going to be preparing gift tax returns. And I'm just trying to say, here's what a gift tax return looks like, and here's some of the issues you're probably going to be confronting during the preparation of the gift tax return. That's all we've done. To say that we have even scratched the surface of this would be an absolute lie. Okay? So the question you just asked, what if I give a non-cash item? That turns on how measurable by third parties is that non-cash item. So I'm going to say I got Berkshire stock, publicly traded, and I have Let's stock. Both happen to be worth $500,000. Since I have a publicly traded stock, which is verifiable by third parties, then I can run that through and have no problems other than now measuring against what exemption did I not use, the same way we did before. Now with respect to Let's stock, I can say it's worth 500,000, but let's pretend for a second it's worth 10 million. Is my goal to preserve exemption or utilize exemption? Preserve. Because I want that to be there for the next tranche of gifts that go to my family. So if I say my Let's stock is worth 500,000, but it's really worth 10 million, did I preserve my exemption? Yes. So when you have these non-cash items, in order to put them on a gift tax return, you have to go to Let's M&A Group and say, can you do a valuation, an appropriate level valuation on this particular asset? And yes, I can. So now Let's says, you're an idiot. I'd buy it for $500,000, but really it's worth 10 million, and here's your valuation report. So now when you disclose on your return, you have a third-party valuation that says it's worth 10 million, not 500,000, because I was being a pig. And there's something called adequate disclosure. So I'm going to put push adequate disclosure aside for just 1 second. Chris, what's the standard statute of limitations for income tax return? How long can they look at it?
Is it like 7 years?
7 years? Well, you're going on the outside. That one would be 6. But how many?
3.
3. That's the general rule, is 3. 6 years is if you understate your income by 25%. So there's a good rule of thumb in that. Okay, if you're going to cheat, never cheat on the income side of things. Count every dollar of income. Cheat on the expense side, because statute remains open in connection with income. So if I have $10 million of income and I say, screw it, it's $5 million. Well, that's more than 25%. But if I say I have 10 million of income and I say 5 million of expense, still 5 million, well, statute's not open for expense. Now it is for fraud. Now if you completely do fraud. So if you're going to cheat where it doesn't look like you're cheating. Don't take advice from me. Okay, so the standard statute of limitations is 3. The statute of limitations associated with gift tax return, I think also is 3, except it has this concept of adequate disclosure. So adequate disclosure says, if you have this non-cash gift, you have to put the amount on there and you have to disclose exactly how you arrived at that value. And so the IRS has a 3-year window to examine whether your methodology was good. So if you don't adequately disclose, then statute of limitations on that return is open forever. So non-cash items is a little bit more tricky.